Hi traders, my name is Chris and I've been doing Elliott Waves for 15 years. Perhaps you've seen my wave analysis 5 to 10 years ago with Admiral Markets and XM, for instance. And I love the Elliott Wave patterns, uh, but it's not as easy to master and understand. It gives you a lot of context, but I think it's difficult to translate all that information into actionable trading. So I think that a lot of traders kind of struggle with that. There are some, of course, that think that the Elliott wave theory is perhaps too complex or complicated. Others might not be able to apply it to the charts, whereas maybe a third group get the context and are able to do deeper analysis, but miss that translation into actionable trading decisions. So I think those are three groups that have difficulties with Elliott wave theory. Let's take a look at an example. For instance, here we see an ABC up, we see a move down, and then a correction. And I think with Elliott wave theory is that you kind of get, could this be a wave one, two, three then? But you see it move to the upside instead, and you might take a short, for instance, trade, and you see price moving up, and you get kind of trapped in the directional problems, perhaps sometimes. Um, it's just an example, okay? So I think that a lot of traders also get stuck in overly simple kind of analysis or overly complicated analysis, right? And it's difficult to find that balance. That's my impression after doing 10 years of webinars and talking to traders in those webinars, for instance. So what I like about using moving averages, the ones I use, which is 21 EMA and the 144 EMA, is that it gives me a roadmap of, and it gives me the ability to understand the waves without necessarily knowing the wave count exactly. It doesn't mean that if you like counting waves that you have to stop with that. That's not necessarily so. But for those that don't like waves, I think moving averages give structure and ability to read waves um, to a good degree without necessarily knowing the exact Elliott wave count. And what I use also are some of my indicators like HMA that give momentum, the moving averages for the trend. And then I also look at how far has price gone from the 144 EMA, which is my ET zone indicator. It gives the distance away from the 144 EMA. And as you can see, let's take a look at this example. When there's bullish momentum, okay, and then we see price that's trapped around the 144 EMA, it acts like gravity. And we see kind of a break, pullback, and then a continuation. And you see that here, price is pulling away from the 144 EMA because it's going further than ET levels 3 and 5. Those are the ET zones. They plot those levels. You see a failed move to retrace back to 144 EMA, and then a continuation up to ET level 7 and 8. All right, we see momentum is in the market. The candles are blue, and we see a push up that is longer, larger, and more impulsive. So I think it gives kind of a roadmap um, that helps balance context and understanding of the charts versus oversimplified, you know, indicators or ideas. Let's take a look at that step by step. Okay, so first, let's take a look here at a blank chart. Okay, one could see a downtrend, obviously, but a very strong push up, which is a wave. Let's say it could be a wave A, right? Because that's typical, right? A very strong impulsive move could easily be an ABC pattern. Here, pink for such a move. Then we see actually a corrective wave B, and then we see a break above the resistance and the flag. And we could easily think from an Elliott wave perspective that the wave C has started. We would expect a bullish price swing, right? But what happens? It doesn't. It goes flat, it starts to move lower, slowly but surely breaks support, and then actually starts to accelerate that impulse to the downside. I know it's an isolated example, of course, right? But I'm just trying to give kind of some of the problems that you might face as the Elliott Wave uh, uh, pattern analyst, or even if you're not an Elliott Waver, right? These are things we run into. And I'm not saying this solves all your problems, okay? All trading involves risk, uh, but I think analyzing it with these tools helps understand the structure of the market better, in my humble opinion. And why is because I think it gives more information in a faster kind of overview. Let's take a look here. We can see that price is below the 21 EMA. The candles are red. So it gives, I think, that information already quickly and cleanly. We see a move up, right? But then we see price stuck in the 21 EMA and then breaking below the 20 EMA, okay? And price never breaking above key resistance levels. I'll show why that's key resistance in a second when I add fractals. But instead, moving below key support fractals and showing red candles with the 20 EMA zone being bearish. And if you are Elliott Waver, you might label it something like this, perhaps. So does this, help my analysis? For me, yes. And I think that other traders might also benefit from analyzing it in this way. Okay. Now let's add a little bit more context to this analysis, right? Let's add the long-term moving averages. Here you can see this 610, the 233, and the 144, all based on Fibonacci sequence levels. Let's add the HMAs, the long-term HMA and the short-term HMA. I have also the momentum diamonds that indicate how many candles are below the 21 EMA. 8 to 10, 8 to 12 I use, as you can see. And the fractals. And you can see that there's a support fractal below the 20 EMA. All the moving averages are aligned. HMA angles are bearish. And once that all happens, there's a lot of confluence. And then the probability, what I've seen, and of course anyone can look at the charts themselves. Of course, there's no guarantee that the price will behave in the same way. But I think the probability of analyzing the chart with these methods helps to understand the context better and to find opportunities that are more favorable. Okay, because everything is aligned. You can see price retraces back to 20 May, and then falls to those ET zones for further extension. Let's take a look at the continuation because after the retracement, we had a big spike up. Price was not able to break above that resistance. As I mentioned, you see the red box. Price is not going through that level, but it is going through the green support level. We see everything aligned from the moving averages, from the trend and the impulse point of view, right? The HMAs and the moving averages are down. And price and the fractals are also showing lower lows and lower highs, right? Which is the official definition of a trend, right? Used in the technical analysis world. And we see price finding its kind of momentum as it goes into these larger spaces, as it pulls away from that 144 EMA. Now, eventually, of course, the trend doesn't go on forever. It finds exhaustion, a final push lower here. There is divergence between the bottoms, and you see the blue arrow, price retraces back to the 144 EMA. Okay. But I think with the moving averages, fractals, and understanding that when price is moving away from the 144 EMA, there's a higher chance that it will move away a little bit further for a while until it's overextended. I think helps understand the charts in a deeper way and faster as well at the same time. I think it gives understanding to the structure, cleaner and quicker, and we can collaborate and understand the probabilities for trading opportunities. By using these moving averages, we can see the spaces, right? When price retraces back to the 21 EMA, it's a pullback. Then if it breaks above the 20 EMA, there's a potential for price to retrace back to the 144 EMA. If it breaks above the 144 EMA, then we're typically in a new trend. It could be a wave 3 or extended wave C. Within wave 3, there could be minor pullbacks to the 21 above the 144, down to the 21 EMA, a couple of times that act as support, not only on this time frame, but also on lower time frames. And eventually price will go back to the 144 EMA and act as a bounce or break spot. So I think that the 21 and the 144 EMA are very interesting decision zones for price. When price is below them, it could retrace back or pull back to them. And then if there's a break in the opposite direction, there could be a new trend. And then those moving averages will act as support rather than resistance. Okay? So I think a lot of interesting info can be used. And it kind of provides, in my view, a very interesting roadmap for understanding where price is. Not only on this time frame, but on all time frames and different types of assets that are liquid and have enough participation, of course, like euro dollar, pound dollar, dollar yen, obviously, Nasdaq, Bitcoin, gold. Okay, it basically shows at what cycle and stage price is. Okay, so if price breaks above the 21 EMA, there's that potential for price to reach the 144 EMA, although it's counter trend. If price is at the 144 EMA, there's that potential for a bounce or break decision. And then, of course, I think it's still important to wait for confirmation from price action to tell me which is the most likely. But we have that understanding that this is an important zone. And then when price respects the 21 EMA and then breaks above the 144 EMA here, and then starts to make pullbacks that respect the 21 EMA, we see that this could easily be a wave 1, 2 with the A, B, C, and 2. And then this could be a wave 1, 2. And then if it starts to break above the higher ET levels, that this could be a pink 3, for instance, with a pink 4 and then a gray 3, right? It helps give that context. So here is a schematic, right? Orange and green is 21 EMA, purple is that 144 EMA. And this is how I try to understand the wave patterns and the Elliott wave theory better, how I try to understand the markets quicker and cleaner, right? And you can see that how important in my view, how interesting it works and how much information it gives me to read the markets in a deeper way with the schematic, right? You see 21 EMA being resistance, then turning into support, 144 EMA being resistance, but as price breaks above it, then turning into support again. Okay. This is a roadmap, right? This is a reversal trade. Wave 1. Wave 3 and 5 is also a reversal trade. Then we get with the trend setups when price is breaking above the 144 EMA and pulling back to the 21 EMA. The same thing for the downside, of course, with the trend setups at wave 2 and 4. And the wave 3 could be traded on lower time frames, for instance. Same for wave 1 and 5. So this is how I try to use the structure of the chart for my trading decisions. So the FS method tries to help traders understand how to trade and how to analyze and understand the market, the chart patterns quicker and with more depth by identifying the market phases and transitions with clearer rules, making it less discretionary, and we have a kind of a mix of discretionary and rule frameworks. Okay, so FS method basically makes a mix of that. We have education, we have that software that explains, although you can start right off with the 21 and 144 EMA just like that and try it for yourself. And if you like it, come back to fsmethod.com, link below. Okay. Um, and we have more education there. I explained the software as well, if you're a member, and our frameworks of how we look at the markets. So if you like this, if you think this could help your analysis, check it out. Try it yourself on your own chart. And if you like it, come back to fsmethod.com and check us out, what we have to offer. All right. Hope to see you as a member. And in any case, wish you good trading and a great weekend. Cheers. Bye bye.